Hello, and welcome to The Big Questions, a new monthly podcast series where we explore a range of perspectives on the major themes guiding the economy and markets longer term. I'm your host, John Briggs, and for our inaugural episode, I have gathered a few internal experts to discuss the outlook for China, where the earlier than expected, and some would say abrupt end to its zero COVID policy is viewed by many as likely to have a significant impact on the global economic outlook in the year ahead and perhaps beyond. But just how significant? Have investors gotten ahead of themselves by estimating the potential upside impact to growth, inflation, and commodity prices that may stem from China's reopening? Are they actually underestimating the longer-term downside risks? For example, the potential for further domestic or regional instability, or wariness from the global corporate landscape to reinvest in China for fear that yet more lockdowns could gum up international supply chains. To discuss this issue from both sides, I'm joined by Ross Walker, our chief global economist, Galvin Chia, our EM Asia strategist, and Brian Daingerfield, our co-head of G10 FX strategy, who also analyzes energy for us and is in the bull wing regarding China in 2023. Let's start with Galvin in setting the table. Galvin, I think it's fair to say the end of zero COVID in China has occurred earlier than we expected. So what in our view has changed given the policy outlook, and what has stayed the same?
Yeah, I think that's a really good question. I think in terms of what the zero COVID policy meant for Chinese economic activity, we identified it last year as one of the key constraints to economic activity. And now that we've seen it being removed so quickly, I think most people are now expecting at least a 1 percentage point, at least increase in GDP growth for 2023 compared to, say, earlier last year, right? So I think in terms of that reopening effect, we're going to see a lot of pent-up demand, both within China and leaving China into regional countries. And so that's really going to change the game for the rest of the world and for the rest of the region as well, right? I think on that angle, John, you mentioned earlier that there may be sort of inflationary impacts or sort of global knock-on effects, right? I think that's going to be seen pretty closely. As we see Chinese consumers domestically start to consume more, as we start to see the stimulus and confidence in the housing sector start to pick up from very, very low levels, inevitably we're going to see that commodity demand rising as well. And of course, everyone's worried about that because China is the world's largest consumer of so many commodities. And so people are worried that at a time of still high inflation, if that's going to increase inflation further. The other thing that people in the region are definitely talking about is the return of Chinese tourists. Now, Chinese tourists have perhaps gained a certain reputation for themselves for being particularly large spenders, and particularly sort of noticeable in how many people tend to congregate in tourist hotspots, right? Particularly in the region. So if that's going to have an inflationary impact on services, now definitely that's helping buoy the prospects of some particularly largely tourist dependent economies in the region. And I think the prime example of that being Thailand in Southeast Asia. I think it's also worth putting into perspective, though, right? Like there's been so much, the abruptness of this policy change and how it came and coincided really with the change in the calendar year has meant that people, I think, have been, as you say, have been very bulled up and have reacted with quite a lot of shock with how much, how quickly this has come and the potential impacts of that. So I think putting this into sort of greater perspective, we think about this in terms of relative terms and in absolute terms. I think in relative terms, after what really was an annus horribilis, if you will, for China's economic activity last year, by definition, this year is almost has to look better, right? If you put it from a very, very low base, that relative step up in the economic activity is going to be pretty massive. But on an absolute perspective, if we're thinking about the levels of GDP activity and the levels of GDP growth, which both sort of institutions and market participants are thinking about right now, some of the more optimistic scenarios are envisioning something around the order of 5.5% to 6% year-on-year GDP growth. That compares with basically what before the COVID crisis was a long-term average of about 6%. So I think in sort of those more absolute terms, you're seeing that level of growth sort of really coming down in a very sort of structural way. So I think there, it's important to sort of try to balance up that relative angle absolute angle, but also to acknowledge the fact that, you know, this is a huge change for China compared to the policy direction and how the economy has been shaping up over the last 2 years during COVID.
All right, Galvin, let me just quickly follow up on something. So that's like how, you know, we've looking at the improvements in the reopening, but what about some of the longer term policies? Does this have any impact on, you know, the whole common prosperity theme or property sector or policies? You know, what other are those policies going to be more of the same of last year, or do we think there could be changes on those policies also?
Yeah, right. That's right. I think that's a really relevant question as well, John. So I think, you know, let's talk about, let's say, like the property sector and the economic angle on that first. Part of this reopening package was a pretty definitive policy pivot that we saw during, you know, the Communist Party's, sort of December economic work program, right? And what happened there was they signaled basically, you know, this idea that the markets should come first, that the economy should come first, that they should actually lend more support to the property sector. Now, I think, you know, what we're thinking from our perspective is that, you know, this doesn't necessarily mean that you're suddenly seeing a ramp up and sort of you know, properties, the property sector being all balled up on a flood of policy stimulus. But I think what this means is that we're going to see sort of the you know, house prices, the housing sector, housing supply stop contracting at a very low level. You know, right now it's somewhere in the order of, you know, negative 40% year on year, let's say, for the December prints. But, you know, that can potentially move back into slightly negative, if not slightly positive terms, right? So I think in that sense, the policy signals have really changed. They've also been starting to talk about, you know, less policy crackdowns and easing of policy on the tech sector as well, and that's been weighing on the Chinese economy for quite some time as well. That being said, you know, you mentioned quite critically this idea of common prosperity, which was, I think, a little bit of cause of concern for some market participants and investors when that was first announced in 2021. I don't think there's any signs of common prosperity being abandoned. It does definitely feel like, you know, common prosperity was a very central part of the ideological drive behind President Xi Jinping. And it does feel like, you know, that's probably more just taken a back seat, you know, back to this idea of, you know, what we saw in earlier decades of Chinese pragmatism, you know, focusing on the economy. You know, perhaps we're seeing that market-based pragmatism emerge, you know, for the course of 2023. But, you know, once the recovery is well underway, then perhaps policy risk, you know, policy directives could come and creep back on us.
Okay, thanks. So Ross, what do you think? For the record, I find myself a bit more on the near-term pessimism side, though open to better data in the back half of the year. Do you think we should not get ahead of ourselves on the upside risks stemming from China's reopening?
Yeah, I tend to lean that way a little bit too, or at least from a sort of Western perspective. I mean, as Galvin has articulated, just by definition, the base effects, if you like, of China's reopening will have a material impact on Chinese GDP. Even if, as reopening occurs, it may not be quite as smooth and as linear, perhaps, as some expect. There may be bumps along that road, but nevertheless, full year GDP in China, you know, at the tail end of last year in our sort of global economic forecasts, we had 4.7% GDP. I think we probably now almost certainly have a 5% handle on that figure. For the Asian region, again, I think you can see there's a powerful argument that pent-up demand in China will have quite powerful spillover effects, tourism being one obvious channel, but global production chains as well. You shift the focus to a Western perspective, though, I think it's the impact of this will probably, I think, be more evident in inflation than in growth. And one of the things that strikes me about where markets are today, certainly from an inflation perspective in Europe, you know, we've seen a dramatic scaling back of wholesale natural gas prices, essentially a halving since the autumn of last year. And obviously this is having mechanically a pretty big downward effect on inflation expectations, on market pricing. That has implications for central bank policy and is driving a more dovish view. And I think fundamentally that is what has been underpinning this this sort of benign period for risk assets. But if the inflation dynamics start to change, and as I say, in a lot of these commodity markets, you don't really see much impact yet, I would argue, around this China reopening theme. This could obviously have an impact on the extent to which central banks in the West, particularly the Fed, but the ECB and the Bank of England as well, will be able to cut interest rates. We've been quite skeptical about the idea of a 2023 policy pivot moving to rate cuts this year. And if there is an additional inflationary impulse through those commodity channels from China reopening, just I think in the current environment where domestic inflation is still suffering from those knock-on second round effects, we've got wage inflation processes running, way ahead of, rates that would, over the medium term, be consistent with inflation targets being met. This is going to be problematic for Western central banks. So for me, the sort of optimism around the China reopening is tempered, or I think as I say, from a Western perspective, it's one where there are probably bigger, or at least more near-term inflationary consequences before any of the benefits of that those stronger growth multipliers feed through.
All right, we'll turn now to Brian. Brian, you've thought there for a while there's upside against, let's say, our base case scenarios from what we've heard out here. Now, why do you think that?
Sure. Well, thanks for having me on. For me, I think the biggest consideration here is that across global economies, we generally underestimated the speed of the reopening and the impact from a growth and inflation perspective. And in a lot of economies, we're still dealing with the aftermath of that, right? The fact that we have policy rates rising across the world, the fact that we're even talking about Bank of Japan having potentially moved away from yield curve control. These kinds of conversations wouldn't be happening if the reopening of the economies were going generally slower and had been had sort of come in line with expectations that it would be sort of slow and tempered. That, the animal spirits type arguments across most Western economies, certainly the Western economies, really pushed forward. And now we have economies that in a lot of cases where the inflation that we have is really services and internal sector driven rather than simply due to supply chain shortages and commodities. So, we look across the world and we see having underestimated a lot of recoveries in the post-reopening landscape. And now we look to China and apply the same playbook. Now, I think the points made by Ross and Galvin are really good. And I would echo them both to say that it is very clear that an initial jump higher in growth expectations should and has happened. The next question is, what does it take for the outlook to improve materially from here? And I think the question the market is facing, and certainly we're facing here, is, has the best already been priced in this early stage, that we've had this one-time snap higher in growth and inflation expectations that comes with the reopening, but that the rest of the recovery is going to be a bit more mixed? Now, I'm personally optimistic, but I would point towards a couple of different factors to consider as we think about this reopening versus other reopenings. The first one comes on the stimulus side, and Galvin, I think, did a really good job talking through some of these points about, is China willing or able to produce, in this case, I guess you would call it pro-cyclical stimulus, to try and boost the recovery in the way that they have done in the past? Is there a desire to not overstimulate the economy? They want to continue. Is there a desire not to encourage excess leverage? Are they worried about property markets? Because maybe that could be a big difference between this reopening and previous reopenings. In previous reopenings, you were benefiting from massive amounts of stimulus across global economies. In this one, we would need to see if that stimulus were to be able to come through, because it's debatable how much the stimulus from governments was a driving factor behind the speed and veracity of the reopenings. But in this case, it certainly looks like it could be different. And the second one comes down to the global synchronization of the reopenings, that China is reopening in a very different phase of the global economic cycle, that when the US and Europe and the UK and most Western economies were in their process of reopening in a significant way, number one, they were all doing it together. And number two, they were all doing it with massive amounts of stimulus coming from each of them. Now China's reopening into a much different global environment, one where global growth is generally seen as on the downtrend from a very strong couple of years in the immediate post-COVID. And so China reopening in that sense is almost counter-cyclical, where the rest of the world seems to be moderating, whereas China is adding a bit of positive spin on that. And so I think it will be a different reopening when we think about it from a global perspective. We're coming off of very pessimistic levels in terms of global expectations. I think it's right that we have seen an initial adjustment higher. The question from here will be, do we need to see further adjustment? I'm more open, I think, than most to the possibility that, yes, we do need to see more. But I think that will be the big question. And I would look to those two big factors. This is a less synchronized reopening compared to other global reopenings. And this is one that might not come with the same level of massive stimulus we've seen in other economies.
Following on the animal spirit comment there, Galvin, do you think that we're going to see a similar kind of animal spirits coming out of China? Or, Brian's right. I mean, we had that synchronized Western emergence, within quarters, I would say. But the West did occasionally revert to lockdowns in order to slow the spread or regional measures. I think that attitudes or even kind of conditioning to fear the virus, that kind of thing, is a little bit different in China than the West. So do you think that you will see that big animal spirit kind of emergence from a consumption side or tourist side or do you think there's a risk that fast rising caseloads, relatively low numbers of fully vaccinated citizens, and even, worries about the limitations on the healthcare sector, that could China, pull back on any of that reopening and then maybe damaging those animal spirits? Or are we past the point where, peak cases, peak fatalities, some of those things maybe are already behind us?
Yeah, I think that's a very big question, John. So maybe let's break it down to two parts, right? So number one, are we at risk of backslipping into lockdowns and tighter social controls? And number two, is there enough juice behind a consumer recovery to really propel it through into a more optimistic scenario? Right. So let's say number one, I think we well and truly are past COVID zero. The sun has really set on COVID zero, on the COVID zero policy. Despite all the sort of political capital that was put behind it, you're definitively seeing now, all of the sort of top bodies from the government, from the National Health Commission, they are all downplaying the potential effects of COVID on individual health, right? They're putting it, they've basically downgraded its importance. They're suggesting that people not go to hospitals if they have mild or asymptomatic cases of COVID. They're removing a lot of constraints on mandatory quarantine periods. And I think the policy response, the language, that's all really pointing into the direction of let's all live with COVID, right? Anecdotally, the stories of household curatives, right? This idea of drinking lemon water to make you feel better. Well, soon after, in early January, there were stories of lemon shortages in many of the major cities, right? The idea of taking Panadol or ibuprofen, right? There's stories about Panadol being scalped for 10 or 100 times the original price in places like Hong Kong, right? So very similar effects. And I think on that front, there really is so much, and like you said, the case numbers are soaring, and we haven't seen lockdowns as of yet either. So I think on that front, we well and truly are past this era of COVID zero. And I think the expectation there, or perhaps the assumption there, is that we move to a reasonably full part of reopening, whereby people really are just back to their normal lives and forget everything that there was about COVID zero. Now, whether or not that's going to produce a enough of a consumer impetus, without the amounts of stimulus that were pumped in, by the sort of Western economies, I think that's a little bit more challenging. I think in the initial part, as Ross might have alluded, right, like we're going to definitely see a bumpy consumer side economy. The economy is going to be challenged by some of these opening hiccups, by people sort of self-restricting, by people getting sick and wanting to pull themselves out of work or out of school. That's definitely going to have an effect. But I don't think that's anything that the Western economy is reopening. That's not anything that's been completely alien to the Western economies reopening either. In places like Australia, places like the US and UK, you did have that sort of initial opening spike, and I think anecdotally you do see people were initially worried after the reopening as well. I think for me overall, I still feel a little bit more balanced on the consumer sector recovery. Right, by definition, as exports fall in China because of this soft global growth, consumption and investment will have to rise, take its place if China is to meet these sort of growth targets or growth estimates of 5% and upwards, right? So there definitely is scope for consumer recovery. But is this going to be a sort of huge inflationary event, a huge build-up event, as Brian was alluding to? I don't think so, because whilst there have been excess savings, you haven't seen the amount of consumer side stimulus fundamentally that we saw in the likes of the US or even the UK. So I think there the calculus is pretty different, and at risk of sounding too much like a moderate, I think it's probably it's got to be somewhere a median line between being overly bullish and overly bearish on that.
Thanks, Galvin. All right, taking a little bit of a further step back, and this one's for Ross. So, over the last few years, China's lockdowns, some geopolitical issues and wariness, you've started to see a lot of companies, large regional and global companies, start to talk about diversifying their supply chains away from China. Do you think that as we reopen, that reverses at all? And what does that mean for China's longer term growth prospects? I mean, how do you think about this from a global perspective?
Yeah, I mean, this is it's a crucial issue. It's also, I think, it's very complicated. I mean, I think one of the features of the pandemic was, and perhaps with hindsight, one of the features of the pandemic that as economists we could have probably forecast better was the extent and the implications of the supply chain disruption. The pandemic itself and some of the sort of the healthcare consequences and the speed with which vaccines were found and so on, I think are beyond the sort of forecasting capabilities of economists. But the supply chain bit, I think, was the part of this where forecasters didn't really cover themselves in glory. And the reason for that, I think, was because we just became so complacent, so used to these frictionless, ultra efficient, highly integrated, complex global supply chains functioning without any difficulties. And COVID does feel, one of the legacies of COVID, it feels like this is where there is a bigger structural change coming. And in reference to China, I mean, you could argue that some of these trends in terms of investment moving sort of offshore to other centers, this was already beginning to happen, certainly at maybe the lower value added production end, where from a sort of cost perspective, China was no longer necessarily the sort of favored area within that Asian region. So you've got some of those forces as well. And then the other sort of layer of complexity at the level of the firm, that even within particular sectors, you see a big divergence in terms of firms' operations. So Apple, for example, still have extensive, very embedded local investment processes, production bases in China. Samsung, for example, have we've seen more sort of diversification moving to other sort of centers. So it's hard to answer. I think it's against the sort of the general backdrop where, I mean, this feels like a sort of less economically friendly, economically liberal world where the tendency maybe to onshore and to try and reduce some of the complexity around supply chains. These features suggest to me that the sort of FDI flows, although you will inevitably get a bit of a bounce on China reopening, that structurally there is maybe there's certainly a moderation here, maybe not an outright reversal, but from that perspective, and maybe in relation to that, maybe some of the sort of geopolitical tensions, not just in China but elsewhere, will induce a bit of caution in terms of global investment processes by companies and where firms locate. But the bottom line is still against that Asia is going to be the strongest sort of growing region in the world. There is still scope for some catch up in a number of economies, and so overall there's a huge mix here. And are we going back to the sort of the growth rates that we saw in the decade up to the global financial crisis? Probably not, but I suspect ultimately we will see less of a moderation in growth in Asia than you will see in Europe and the US. But it's as I say, it's an incredibly sort of complex question from a macro level, and probably ultimately one that over time you'll get a bit of greater clarity from in a sort of a bottom-up sense, looking at what individual companies, particularly those large, well-known global multinationals, how they begin to restructure. I think that'll be certainly something to watch.
For sure. So when you look back at the last couple of years, I guess at this point, supply chains and energy have been two of the major issues. So Brian, putting on your energy hat, what does this mean for global energy prices? And I think maybe just spend a minute on, our overall view coming into this. Do we think they were going to be declining, rising, staying around the same? And then, does this China's reemergence put in upside risk, or do you think that's price?
Sure. Thanks, John. So on the energy side, I think it's very clear that China's reopening is an upside risk. It's just really a question of how much and when does it hit. Even if you don't think demand in China is going to be particularly strong, even if you're on the pessimistic side of the coin on China's reopening, China is still, the reopening at all is still allows China to be more of a competitor in the energy space, as in, a big part of Europe's essentially, natural gas storage buildup over the summer, it's, I don't want to say aided by, but their ability to achieve that level of stock build was, part of that was because there was less demand from China because of the zero COVID policy and just weaker growth there. So you think about what the next summer will look like, and I think we're all hoping for a positive resolution and an end to the war in Ukraine, but it certainly doesn't look like that's coming anytime soon. You think ahead to 6-7 months down the road when we're thinking about restocking for the coming winter, China's going to be part of that equation in a much bigger way in terms of demand for raw materials across the board, and energy, I think, is no exception here. And so this is a positive for energy prices. We can just leave that aside for a second, but say this is happening against a backdrop of much weaker growth globally than we saw over the last couple of years. And so energy prices have actually started the year in some cases flat. If you think about oil, it's relatively steady, but natural gas prices, as Ross has mentioned, especially in Europe, have come down because of warmer temperatures in the region. So energy prices have come down. I think that's a combination of growth expectation factors, but also a weaker dollar. We can't leave the dollar out of this as the denominating currency. The dollar has come off its highs. And so dollar denominated assets of all kinds have appreciated in value, and that includes commodity prices. So this is a positive. I think it's going to make it difficult for energy prices to fall sustainably. But the question about, is this a big positive? Are we talking about, several tens of dollars higher in oil prices here? I think that probably depends on some of the questions that we've been talking about here. Do we have a real consumer stimulus-led recovery that can push these narratives further in China? Or are we talking about a more a slower recovery where maybe the best of the expectations are already in the market now? So I lean positive on energy prices. We came into the year leaning positive, thinking that, hey, from a supply perspective, we still think there's not enough to meet the demand, even though demand is falling. Clearly, the market is looking forward to weaker demand, and a weaker dollar is also putting some downward pressure on energy prices. Feel like a lot of that move is now in. I think the risk reward probably still leans higher, but I don't think we're talking about a return to, say, the early stages of the Ukraine war when we were talking about significant boosts in energy prices. So energy prices that stay high enough to remain a challenge for growth, but not move so much higher that we're talking about the big risks to inflation that we saw early last year on the headline side come back into play.
Okay, thanks, Brian. And then for you from a G10 perspective, but then maybe starting with Galvin on dollar China or just the currency in general. What are your views here for applying everything we've heard for what does this mean for the currency and for those that either want to trade it or need to hedge for it or account for it?
Yeah, I think, coming into this year after all that reopening news over the sort of the turn of the year and the Christmas holidays, I think that really meant that, dollar CNY, dollar CNH actually does warrant a much sort of stronger appreciation path, right? And if you couple that with the fact that, where we've been thinking about, I guess, the idea that the dollar should be weaker as well, this idea that, as China returns to normality, it should benefit from the weaker dollar and it should recouple with the direction of travel with the broader dollar, i.e., we should be removing sources of uncertainty. We should be removing sources of, these sort of drags on currency performance, right? And I think what we've been seeing sort of in the early parts of this year, the first, 2.5 weeks or so, is that we've seen this optimism play out a little bit too quickly. I think rightly so, as we head sort of into the Lunar New Year time, that some of this optimism is starting to wear off. Chinese exporters will be selling less dollars to convert into local currency, to pay staff bonuses, to pay wages and the like before the long holidays. Some of that's easing off as well. So I think some of that rapid appreciation that we saw in the beginning, sort of the first couple of weeks of the year, are definitely starting to peter out. I think that's right. But that being said, I think this path of recovery, is correct. But that needs to eventually be substantiated by better domestic performance, or perhaps even by sort of portfolio inflows reallocating into China. On the other hand, I think one interesting perspective that we do have, which is a bit of point of contention across the sort of analysts in the markets, is what's going to happen to China's trade-weighted index, right? Like the CFET's basket, its basket of trade-weighted currencies. Our view there is that that's going to weaken, right? So whilst the renminbi can strengthen against the dollar, its trade-weighted basket will weaken against its peer currencies, because of the fact that over the last couple of years we've seen that move closely with the trade balance with exports, and we expect that the trade balance and exports to sort of come off quite significantly because of a weaker global view. So I think sort of a bit of contrast there, and perhaps some divergence with some of the analysts out there in the markets.
Brian, anything from a G10 perspective?
Sure. So our expectation for the dollar is that it continues to weaken, though I'm sympathetic to your view, Galvin, that we have come a long way in a short time. But a lot of the themes that were dominant in the dollar rally last year have really shown signs of easing off or even reversing. You think about two of the big ones: relative growth, relative monetary policy. On the growth side, this is where the China reopening really comes in. In 2022, you had consistent outperformance of the US and steady weakness in Europe related to the war in Ukraine and energy prices, and also in China due to zero COVID. Now you have some big shifts in expectations around all of those themes. US survey data continues to moderate. The Federal Reserve looks likely at this point to slow their pace of tightening further to deliver a 25 basis point rate hike at their early February meeting. And then on the China side, you have the reopening from zero COVID. So from the US side, you have some softening up of those themes from relative growth and policy that have been such a strong positive for the dollar. And from the external side, the ex-US side, you have these two positives, at least against a backdrop of very high pessimism. I don't think anyone's expecting this to be a year where European growth explodes to the top side, or that, for example, but we are coming off of a fairly pessimistic base. And so those two trends had both pushed definitively in favor of the dollar in 2022. Valuations got to very rich levels. Now those themes have moderated, and in both cases, I think it's appropriate that we've seen the dollar weaken as it has. To the point you said, has it gone too far too fast? I think that's a debate worth having for sure, but I think the medium-term picture is still, we don't have the Fed constant upside surprises from hawkish policy shifts. That period is likely behind us now. And so the positives coming for the dollar from the Fed and relative policy side are probably waning. And then from the relative growth side, I think it's clear that we're seeing some cracks in the US economy as well, whether it come from survey data or from interest rate sensitive sectors starting to feel the weight from the Fed's tightening cycle that we've seen to date. And so still think that the medium-term trajectory for the dollar is weaker from here.
Thanks, Brian. Now, we can't close any China podcast without bringing in some sort of geopolitical angle. So, Galvin, you get to be put on the spot here for this one. We've had some shifts in policy. There's obviously increased tensions between the U.S. and China. I want to stick kind of just with China itself, even though, we all know Taiwan's potential flashpoint going forward. Domestically, do you think that either these changes in policies or there's any other future risks for just domestic political instability that we need to watch for?
So I think that's actually one of the residual worries that we've encountered with some of our conversations about why not everyone is really getting bowled up about China. It's because people are still worried that there may be sort of residual policy risk, that there's risk of crackdowns, that there's risk of a concentration of power, and hence the likelihood of a pivot. I don't think that that's something necessarily that we should be worried too much about in the immediate term. I think so far, at least for the course of this year, the signals, right, coming from the government and from the policymakers have been that they want to keep this economic recovery humming, right? And that's been pronounced not only to the domestic audience, but also to the global audience just the other day at the World Economic Forum. So I think that's one element. The other element that actually does still worry me is, like you said, this residual geopolitical angle. So there has been sort of better, I suppose, mood music, better headlines coming out about the fact that, you know, the Chinese are replacing their foreign minister with someone who's known to be a bit more moderate, right? They're toning down the diplomatic rhetoric. But I don't think that changes the fact that on the one hand, the current U.S. administration's sort of stance towards trade is perhaps any more progressive than you would expect from the previous Trump administration. Biden has kept a lot of these tariffs in place, kept a lot of these frameworks in place, and really the way that he's approaching sort of China has not been to sort of conduct a rapprochement, but it's been one to say, you know, we're doubling down on strategic competition. On the other hand, you know, the one thing that has not died down, and is perhaps, you know, tying to you know, Ross's discussion earlier on global supply chains, is the chip sector, right? This is, you know, I think the early innings of what is becoming a tech war. The U.S. has been acting sort of in ways perhaps not with a sort of global perspective, but on a sort of bilateral perspective almost, in trying to restrict access to sort of technologies on the Chinese side, right? And really, you know, amidst all that, there is a very sort of vocal and open competition for supremacy in areas like renewable energy, and particularly in areas like manufacturing, as well as in AI, right? That's not going to go away. That's going to be something that's really going to be sticking with us, I think, for the next couple of years. And unfortunately, as with so many geopolitical risks, the market kind of tends to view these events in binary terms. So unless it's really being shoved down our throats, as it were, the market may very well just choose to ignore it for the time being.
All right, well, we'll leave it there. Thank you, everybody. Thanks for my guests for joining us, and thank you, everyone, for listening. Be sure to follow us on social media to get other episodes in this series as they're published. And if you like what you heard today, hit that like button so it's easier for others to find.